Hello, good afternoon, everyone. Oliver Kolofsky, wealth advisor and partner here at Sweet Financial Partners. So wishing you a good afternoon. Hope you're having a wonderful day. So today we're going to share with you a few updates as it relates to the financial markets here. And as always, for those who have attended before, this will be a review. But for those folks who are new, we've got a couple items to share with you. So number one, if you have a question or anything along the way, feel free to type it in the chat box below, or you can also submit Q&A or questions, and I'll share with you an answer, and those will remain anonymous. So I'll read back the questions so all of the attendees are able to hear the question, but I certainly won't mention any names. So that's how that will go. So if you see me looking over to the side, looking at my other monitor here to see what questions might be coming up. So with that, again, we'll go ahead and get started. And any questions, feel free to type those in. So 2023. So when we went over some slides maybe 3 months ago in a format such as this, we talked about, has 2023 this year felt volatility? Felt volatile rather? What type of volatility have we seen? So got a chart here to share with you. We used a slightly different one last time. This one here paints a pretty good picture. So a lot of numbers and lines here. So we'll try to outline here what this is. So across the bottom, we have each calendar year going back all the way to 1980. And it goes all the way up through 2003. They update this data quarterly, so it's updated as of June 30th, but the data is still the same, even though we're nearing the end of September. So the gray bar is the return for the calendar year. In this case, the S&P 500, so like the large cap U.S. stocks, and then the kind of orangish yellow would be the intra-year decline. So for instance, maybe during the year, the market ended up 10%, but at some point, maybe it dipped 7% during the year. So if I use an example of 2000, just pick a random one here, 2014, at some point during the year 2014, from a high point to a low point intra-year in 2014, the market was down 7%. If you had just looked at the market on January 1st of 14, and only looked at it one other time, December 31st, 2014, you would have seen, it went up 11% in that case. So what we want to look at here is the average intra-year decline. So if we go here, I'll bring up a line. So that red horizontal line there, that's going to be about a 14%. That's the average intra-year decline. So this year we've seen about 8%, so less than average to this point. It could always be, something could happen here the last few months of the year. The S&P 500 still up around this number, 16%. That's fairly skewed, and I'll go through that a little bit later today. So from a downside standpoint, this year has been less volatile than historically we've seen since 1980. Last year was much more volatile. We can see that 25% would have been the high to low, or the low to lower might be a better way to put it. Last year was the 25% downside, and then ended the year down about 19%. So that was 2022. So less volatile than normal. And I'm going to contrast that here with, again, 2022. So explain this chart, and I might grab my my pen here to better grab the draw right here. So across the horizontal axis here, well, these are the numbers. The US, that's going to be like bonds or the Treasury. So if they're positive, that's going to be like over here. If they were negative for a year, it's going to be here. And then on the vertical axis it's going to be the S&P 500, so large cap US stocks again. So if we were to look at like this quadrant up here, that's going to say we saw positive returns in both the stock market and the bond market. And if we come around here to the quadrant here in the lower left, that's going to mean we saw negative returns in both the stock market and the bond market. And again, this is 2022. So if we look at, it's going to be the worst year in the bond market, because we would have seen prior to that, it was like 2009, or which number is as far furthest to the left. So 2022, definitely an outlier in terms of how much we saw the stock market go down and how much we saw the bond market go down. So kind of a general statement here. I mean, even though we've seen some decent upside in the markets this year, one could make the case that there could be a decent amount of upside remaining here. So we've got a jar of mayonnaise here, and this will be an analogy. So, lots of people like mayonnaise on a sandwich or in various other dishes, but something I've never seen happen is someone just opening the jar of mayonnaise and take a spoonful and eat it by itself. So mayonnaise, it's great with other things, probably not great as a standalone or by itself. So I don't maybe like tomatoes. I don't eat tomatoes as by themselves, but certainly on a sandwich or in various other dishes, I enjoy tomatoes. So the thought process there is diversification, and I'm going to go to the next slide here. And there's a lot of colors here. I'll explain what it means momentarily. But as we carry through the mayonnaise analogy, it's like something maybe is not great by itself or as a standalone, but mixed with other things, it can be a really good thing or a really good complement to other things. So think of that like investments. Owning one stock or one asset class may not be the right thing, but it might add some risk reduction if owned with other items. So I'm going to grab my pen here again. So this is going back to 1996. So going left to right on the screen, 1996 all the way up through 2022. They update this one annually. So it takes a look at like 7 or 8 asset classes, and it's going to rank them in terms of the best performing up top. This is going to be like the best performing, all the way down to the worst performing for a particular calendar year. So if we look at like 2022 last year, the best performer, if you could have had all of your eggs in one proverbial basket, it would have been large cap value was down 5%. Yeah, but that's the green, and that green is going to carry through. So if you just do a quick scan of where the green is, a lot of times it's kind of middle of the road. The green was never here on the bottom. It was never the worst. Twice, going back to 1996, was it the second worst? And if we look at the whatever color large cap growth is here on the bottom, kind of a reddish orange, that was the worst. That was down almost 30%, a third of the value. Would have been the decline in 2022. Now, if we had like a year to date 2023, the large cap growth would be the best, but it's still not back to where it was. I think maybe it's up, let's just say 20%. But if it's down 30%, then it's recovered 20%. It's certainly not back to where it was. Even if it was down 30% and it was back 30%, it's not back to where it was. So the key thing here is diversification still matters in terms of long-term risk reduction. And it's sometimes it's like, well, gee, why wouldn't I just put everything in, pick maybe some technology stock or something like that? We might think of that a little bit. I mean, sometimes it can work, but we'd think of it in terms of a long-term strategy a little bit more like the mayonnaise, where it goes well as part of an overall portfolio, but as a standalone, maybe it's not the best. All right, I'm going to clear that drawing here. Got one question coming in. I guess this person may have attended when we went through this back in some of these charts back in June. So is technology still the best sector year to date? And the answer to that question is yes. So there was a slide we went through last time that showed that like much of the market returns this year were due to some of these large technology stocks like Apple, Facebook, Google, Meta, Tesla, Nvidia. That is still the top performing sector for the year, although that's changed a decent amount since we last spoke, like in the last 3 months. Other asset classes have kind of converged, if you will. Other classes have done better. Technology maybe not as good over the last 3 months, depending on which particular subset of technology. So, but to answer your question here, yes, technology, which would have been like the worst or one of the worst performing sectors last year, is the best performing sector this year. Yes. All right. Next page. This is a year-to-date chart of three different indexes. So if we look at the purple line, and this probably is a decent segue from the question we just went through. The purple line here, that's going to be the S&P 500. And as the name implies, it's 500 of the largest U.S. stocks. But this is that can be a little deceiving, if you will. So 500 of the largest U.S. stocks does not mean there's 1/500th in each of those 500 stocks. It's what's called market cap weighted, meaning if the company is really big, it has much, much larger than a 1/500th share of the S&P 500. So what can happen is these big technology names can very much dominate it. Last time we showed that like 7 stocks had attributed to all of the return of the S&P 500. Now it's not quite as extreme there, but the purple line is very much seen a tailwind of a handful of technology stocks that have done really well this year. The orange line, that would be the Dow Jones Industrial Average, and this data is as of yesterday, year to date as of yesterday, so up 5.5% for the year. So we've seen positive returns, not back to where it was at the high point, the all-time high point of the market. Generally speaking, and it's going to change depending on which market, but generally speaking, would have been at the beginning of 2022, so very early January of 22. So the Dow Jones would be 30 stocks, as the name implies, maybe more industrial type names, a little more value stocks, maybe not as much technology. That's up 5.5% for the year. The other interesting one, we'll talk more about this one. The blue one is going to be bonds. Bonds, think of bonds generally as like an inverse to interest rates. As interest rates go down, as interest rates go up, bond prices would go down, and as interest rates go down, bond prices would go up. So we saw last year interest rates go up a lot and bond prices went down. They've somewhat stabilized for the year. They're off from their high point for the year. You can see the blue line ever since maybe May-ish timeframe. It's kind of been slowly going down, such that bonds, even including the yield, the bonds are like flat for the year. This would be like investment grade bonds. If you got into like high yield or what are called junk bonds, they've seen a little more positive, but a return this year would certainly have more risk as well. Yeah. So more on bonds and yields here shortly. So this one is as of the other day. This is kind of interesting if you look at different sectors relative to their all-time high. I think sometimes, when we read things or hear things on the news, it's always the market. What did the market do? The market went up, the market went down, the market was flat, the market's at this point, it was at that point. In reality, there's a lot of things that comprise kind of the quote-unquote market. Here we're talking about like the S&P 500 would be generally like U.S. large companies. But there's certainly some disparity in terms of the subset or the sectors that comprise the S&P 500. So this is from their all-time high, and this is as of just a few days ago. So moving left to right, energy, about 2% off its all-time high, very, very, very close. Industrials, 5%. Information technology, that's going to be 6-7%. If we go all the way to the right, real estate or consumer discretionary, 20 to 30% off its all-time high. So share this slide just to show when we look at the market, we don't want to think of the market as just like one thing, that there's certainly various components to it. Let's go through some economic things. We actually got some news here this afternoon. I don't have a slide on, but I'll share it here in a few moments. So inflation. Let's start with inflation. So this provides a little context. This one's updated annually. So this goes back to 1980. So if we look at $1 in 1980 as of 2022, 12/31/2022, it was 28 cents. Yep. So inflation is certainly real in terms of purchasing power. So we shared this one last time. This was through February. Yeah, this was through the end of February. I'm gonna grab my pen again here. I think it'll better illustrate what we're looking at. So these numbers, this blue line is going to be a year-over-year average, or not average, excuse me, a year-over-year change. Yep. So if we were to look on like February of 22 to February of 23, that's going to be this number here, 6%. So once a month, when you hear that inflation was this or inflation was that, that's the number, and the number on this chart, that's the number that's getting reported. So the all-time high would have been in the summer of 22 at just over 9%. So I believe it was either June or July. So June or July of 22 relative to June or July of 21, 9% increase. Sometimes you hear the Fed targeting like 2 or 3%. Well, at this time, February at 6%, the orange dotted line, that's going to be the 3-year average. It was at 5.2. Now let's fast forward to, so this was through February. Let's fast forward to the current. See inflation. Yep, down to 4%. So the year over year had gone down, but then the 3-year average went up. And how that goes up is because it's kicking out, like on the tail end, on the back end of that 3 years, it's kicking out lower data and bringing in more of the recent data that's all been higher. So you can have like a 1 month go down and the 3-year average still go up. So we've seen a decline in inflation according to numbers. Now, it might not always feel like that, but if we look at the kind of the number that gets announced, it has gone down. So the news today, the Fed came out and said they're leaving rates unchanged. So no change in interest rates. They'll meet again at the end of October 31st, November 1st timeframe. Probably a pretty good chance they raise interest rates a 1/4 point at that time. Who knows? But some of the economists are saying that might be a time frame, and they kind of hinted at maybe even raising rates a little bit into 2024. And sometimes when they raise rates, it takes a long time for that tool to work its way through the economy. So when they raise rates, it's not like it has an instant impact. It takes time to work its way through the economy. So sometimes as they raise rates, they tend to overshoot the target a little bit. But that time will tell if that's the case in this time. So this one here is fairly interesting. We get a decent amount of questions on this. If we break down, just like we can break down the various sectors of the economy, we can break down various products or services, goods and services that one might use in terms of the year-over-year change. So if we look at housing, we've still seen a pretty big spike in housing. If we look at the top, food, of course, that would be the one that most people would, see and experience every day. Whether you dine out or go to the grocery store, certainly can see or feel the effects of food. Some people would say it feels a lot more than 6.7%. Things that are down, and this is the data, they update this one quarterly, so the data is actually maybe a few months old here. Gasoline, airfare has come down a little bit. That was up on the top side here. And again, there's a lot of nuances or variables to these, but this is taking everything nationwide. The price changes. Cars are one we've finally seen a decrease on. It'd be interesting on housing. If you look at this, the houses for sale, it seems like it'll say like price cut. It seems like anecdotally, I mean, I don't have hard data here, but it seems like there's a lot of houses that say price cut. So we'll be curious to see that number. All right, I'm going to check to see if we have any questions. No questions at this time. All right. All right, this is one we get some questions about as well. This would be credit card balances in the US here. So this would have been, this big downturn right here would have been the start of the pandemic. So it makes sense or certainly understandable why spending dropped and credit card balances certainly dropped. So now we've seen that and recover, if recover is the right word. And if we were to draw a trend line here up and to the right, we're kind of continuing that trend line such that credit card debt is nationwide almost at $1 trillion, $994 billion is where credit card debt is. When you look at interest rates, I mean, credit cards were always, certainly consumer loans have always had much higher interest rates than, let's say, a home mortgage or something of that nature. So, I mean, maybe a somewhat interest rate driven, the economic impact we'll see. So this is one we'll continue to watch as that credit card number continues to grow. One thing, if you may have caught that if we go back a few slides, it's kind of interesting that even though credit card debt is that high, if we would have gone back here to what's like the second worst from its all-time high, it's consumer discretionary. Typically discretionary items do well when the economy is really well because people have extra money. The consumer staples, think of like shampoo, toothpaste, things people have to buy regardless of economic conditions. Not down near as much. So it's interesting. Consumer discretionary is still down 20% from its all-time high, while at the same time having credit card debt at its all-time high. We'll see how that kind of plays out, if you will. Something internally, certainly we monitor. Another item we're getting a few questions about, or people just curious, if you will. So 2024, of course, a presidential election year. So I want to share some data with you on kind of election cycles and presidential election years. So we've got a lot of data on this one. So if we go back to 1929, this is going to show the return of the S&P 500 for each calendar year. And then it's going to go by president. So in this case, of course, red is going to be Republican, blue is going to be a Democrat in this particular chart. So a couple key takeaways here. I'm going to grab my pen. If we look at the top, this is going to be regardless of political party or affiliation. So the first year of a presidential four-year term, average of like a 10% return, second 8.4, third year 17.6, fourth year 10.9. So the number one thing probably sticks out a little bit, and that's what this chart or this summary is over here on the right-hand side. So we're in year 3. So 2023 in year 3, and that has historically been by a pretty wide margin the best year of a presidential cycle, if you will, in terms of stock market performance. So going back almost 100 years worth of data almost, what's happened this year has certainly held true or continued with the trend that we've seen. Also, and not by much of a margin, but we've seen that the second year has been the worst, not by much, but it has been the worst. And if we think about like last year would have been the second year last year was not a good year for the financial markets. So kind of interesting here. And then the fourth year, next year, 2024, has historically been a pretty good year as well. Yep. And some of those things can kind of skew it. Like the fourth year is still the second best, but 2008, so the financial crisis, was the third largest drop. That's this right here. It was down almost 40%. So it's the fourth year is still the second best, even with like a 40% drop in there. Yeah. So what we've kind of experienced the last few years is, roughly been in line with like a 90+ year data set. Next one. So this would be the election results going back to 1928. And the key takeaway here is that 20 of the 24 years were positive. 20 of the 24 years were positive, and the negative years, there's only been, I think, 2 negative years. Yeah, 2 negative years since 1941 in terms of presidential election years and the stock market return. You can also see if we just glance at it, I don't have the exact number, but if I just glance at this column here on the upsides, you'll see a lot of double digits. So when we look at like 20 of the 24 years positive, it's not like, well, it was up 3% one year and 2% one year. We're seeing a lot of double digit, upsides here. Especially within the last, let's call it, 10 or 12 presidential election years. So sometimes, I mean, it's certainly if you watch the news, that news cycle is probably only going to get more intense over the next 14 months or so, 13 months, and leading up to the election next November. But so this is a key one that maybe you'd want to keep in mind that, it's been contentious before, and it probably always will be. But if we look at like the markets have historically in a presidential year, it's been a good year to be invested. And this is all, regardless of outcome or regardless of party in power or the party that wins or whatever. So we, this is a good data and a large sample set of data as well. All right, I will check to see if any questions. And again, questions, you can type those in the chat box or the Q&A box. I will do my best to answer those. If I don't know the answer, I'll let you know, maybe email you and do some research to find the answer. And we'll keep that all, of course, anonymous. So I'll repeat the question, but I won't say your name. All right, let's talk about some opportunities here. And before we get into some numbers, let's look at what's called the yield curve. And that's going to be interest. Think of the yield curve as like, what interest rate can I get if I invest my money in like a government bond or a government fixed income instrument for a certain amount of time. So if I look at the gray line on the bottom, that was the yield curve as of 2021. That was this one here. And across the bottom, the horizontal axis would be our time frame. So if I invested for 1 month, I'd get virtually 0. And if I invested for, call it 3 years, which would be this point, I would have gotten 1%. And this is as of 12/31/21. And if I would have bought a 30-year at that point, I would have gotten just under 2%, and I would have locked that in for 30 years. So conceptually, it makes sense that the longer I invest, the higher return I would get, or the higher interest rate I would get. And that's how the yield curve, call it, typically is. The blue line, that was 12/31 of 22. Let's focus now where we are as of less than a month ago, and that's going to be the orange line. What we have going is what's called an inverted yield curve, meaning if I bought a 1-year government bond, I could get like 5.3%, let's say. But if I bought a 30-year, that's going to be way out here. It's going to be just over 4%. So the math, or the thought process, is just a little backwards, if you will. That the shorter if I invest for a short amount of time, let's say a year or less, I'm going to get much higher rate than if I tie up my money for 30 years. So that would be called the inverted yield curve. Yep, where it generally slopes down and to the right. That would be an inverted yield curve. Normally, a yield curve would go up and to the right. So we've got really high rates from a historical context, or even from a very recent, from relative to 12/31/21. We're on a 1-year. It was like 0.5%, where now it's 5.2 or 5.3%. So a lot of numbers here, but I want to share something with you, especially for those on you here who live in like Minnesota. So these rates were as of the other day, as of September 14th. These would be U.S. Treasuries, or U.S. fixed income, U.S. government bonds, if you will. And these are going to be like a sample CD rate. So if we look at like 1 year, let's do a 1-year comparison. Because what we're going to look at here is on treasuries, there is no state tax. You're going to have federal tax, but there's no state or local tax. CDs, you're going to have federal and state tax. And if you do this like in an IRA or a Roth IRA, they're going to be like tax deferred or tax free, depending on the type of account you do it in. If you do it in like a non-IRA account, of course, that's what we'd be talking about here. So treasuries, no state or local tax. CDs would have state tax. So let's use an example. Let's say Minnesota, and a state income tax bracket of 7.85%, which that would be if married filing jointly, income ranging from like $175,000 to $305,000 for this year. So if a person did $100,000 into a 1-year investment, that's what I've got circled up here, trying to use some round numbers. A CD, 5.5%. You're going to produce $5,500 of interest, which will be taxed federally, and will be taxed 7.85% at Minnesota. So $431.75 of Minnesota tax. So your amount net of state tax that you'd get, or keep, if you will, you'd get the $5,500, you would just owe some tax. So the amount you keep would be $5,068, $5,070 or so. Where if you bought a government bond, it'd be 5.442%. So the rate is less. So naturally you'd say, well, I'd rather get 5.5% than 5.4%. So a treasury, you have $5,442 of interest net of state tax, because there is no state tax. You'd still have federal tax. Yep. So a couple of key takeaways here as you're talking with your advisor. Maybe you have some excess cash. Maybe you have CDs coming due. This is, of course, be dependent if you live in a state that has a different tax rate or no tax rate, or your income's higher or lower than the example here, the numbers are going to change for you. So this is for example purposes only and not tax advice, but it would be a good conversation to have with your advisor if you've got excess tax or maybe CDs coming due, is how does this apply for you? If I were to go through every scenario up here, there are some situations where it's like the same whether you do a CD or government bonds. But for that kind of short-term excess cash, if you will, There's some good opportunities here. Also, there's Treasury money markets. I think that rate is, as of today, call it around 5% or so. A money market being that it pays interest monthly and it's always liquid every day. You don't have to keep it a set amount of time. So that would be good conversations as you're meeting with your advisor, or you want to, just have a quick call, things to think about, or kind of opportunities that, with what's, kind of, as a raise interest rates, a lot has changed here in a relatively short period of time. All right, I'll pause a moment and I'll clear the drawing there and see if there are any questions. All right, no questions. So those are the items I wanted to share on the market, kind of some of the common, maybe questions we get, or people just curious more so. The good news is, we always want to focus, you and I, we don't control the markets, don't control geopolitical items. Things are going to happen. But the good news is that you and I do control many factors. So just going to run through a few things that we're going to talk about, or we have talked about. I'll continue to talk about with you, for those of you who are clients on this today. How to save if someone's in the accumulation phase. Tax rates are going to change in 2026 unless Congress acts otherwise. But we know January 1st, 2026 tax rates, as the law is now, will change. In most cases, they're going to go up, not all cases. So how you contribute, do you want a tax deduction now? Would it make sense to maybe put more money into Roth right now? That's something absolutely can control that. If you're taking distributions, from which account you take income and when, a lot of control there, not all control. If you have a required minimum distribution, unless you give it to charity, you have to take it. When you start Social Security, how much risk you can take. You can't control the markets, but you can control, risk, how to give to charity, when to give to charity. Spendable income isn't necessarily equal to taxable income. That's a great one there. If someone's under 65, so not on Medicare, and they want to retire before they go on Medicare, is there a way to structure income such that you get lower cost health insurance potentially? How much you spend when you're making large purchases. This has changed a decent amount with interest rates. Cash versus debt on larger purchases. That thought process has changed a decent amount here recently, and the list goes on. This is an illustration. As we kind of run up on time here, an illustration I always want to share. So we think about, like, from which account to take income and when. There's different tax ramifications for everything. If we move left to right, if someone has a pension or land rent, and we turn on that, there's really not any control over that. It's going to be what it is. It's 100% taxable. Social Security, control when you start that. That's in yellow here. That's 0 to 85% taxable. So that's a big range, and it's going to be determined partly by the size of your Social Security, but more so by all of your other income sources. Taxable income sources will determine how much your Social Security is subject to tax. New in Minnesota, we sent this out, I believe, a few weeks ago. If you're a married couple, the same concept applies for single, but the numbers are a little bit different. If you're what's called modified adjusted gross income is $100,000 or less, Social Security is not taxable in Minnesota, and it phases up or out from that. So that's new. IRA is going to be 100% taxable unless it goes to charity. Roth IRA, kind of the ultimate tax-free. Yep, not 0% taxable. And then lastly, on the right, is going to be anywhere from like 0 to 90% taxable, depending on what tax rate you're in, because the capital gains tax rate is completely, or the rates are different than the ordinary income. And that's, I think we've done a few of these on that. So the point here is lots of controllables here, probably the largest of which, or the most notable of which, is from which account to take income and when. You and I have, a lot of control over that. I mentioned tax rates changing. Here are the numbers here. This is married filing jointly. The concept would be the exact same for single folks. The numbers would just be different. So we're gonna, if I grab my pen here. And again, Congress could act and change this, but as the law is today. So here's the 2023 tax rates, and then this would be 2026 and beyond. So it'd be like the first $22,000, it's not going to change. It stays at 10%. The next bracket, 12 to 15. But then you're going to see some decent amount of changes from like, you know, let's say 90 to 364,000 in here. Right now, it might be at 22 or 24%. That could go to 28 or 33%. So there's some proactive things you may be able to do as it relates to tax rates now versus later. The key thing to remember on this, we get the question once in a while, like let's say someone has $89,450 of taxable income. And let's say they have $1 more of income. So their income goes from $89,450, and somehow on the last day of the year, they earn $1 more, and now their income goes to $89,451. Is that a small problem or a big problem? Or is it no problem or a big problem? Because now you've got all of your income is either in the 12% or less. Now you've got $1 of income here in the 22% bracket. Does that mean all of your income is taxed at 22%, which would be, in this case, kind of a big problem? Well, the good news is we really no problem, because your first 22,000 is taxed at 10%. Your next 70,000 or so is taxed at 12%. And your last dollar of income would be taxed at 22%. So you'll have 22 cents of tax on that last dollar of income, but all your other income would be taxed at either 10 or 12%. That's not the case, though, when you're looking at like Medicare surcharges. If your income is quote unquote too high and you have to pay more for Medicare, if you go $1 over that, you pay the full extra amount. Just had a couple other charts here, but in the interest of time, we got a 445. Skip through that. Some new reporting, and all this done through the Dream Architect planning process. So the 4-step process is the planning process that we would go through with you to take advantage of all these tax opportunities, if you will. So while wealth management is what we do, inspiring you to realize your dreams are still possible, is who we are. We've got a phone number here, my email, oliver@sweetfinancial.com. That comes directly to me. If you email me, I will certainly reply. You can forward it. I've gotten a couple questions here. I'm going to answer those, maybe a little more nuanced answer. I can probably give you a better answer specific to your situation. So I will look for those of you, a couple of you who have just but submitted a question. I'll email you tomorrow with answers on those. All right. No other questions. So that concludes today's Sweet Financial Live. Wish you all a wonderful rest of the day, and as always feel free to reach out. We're happy to help, happy to be a resource. So yeah, wish you a wonderful day. Thank you, and we'll chat again. Bye-bye.